Today's lecture is on Chapter 12, which is partnerships. We're going to be covering a type of entity that is set up as a partnership. Now, one thing that you're really going to have to make sure you do is to read Chapter 12, the sections that I have indicated for you to read, and make sure that you can distinguish the difference between the four types of main entities that are in this chapter. Even though this is primarily a partnership chapter, the very beginning of Chapter 12 is all about the different types of entities and why they're different and why a owner of a business would want to choose different types of company setups. One big reason is this idea of limited liability versus unlimited liability is really important. So make sure to read the chapter about all of that. I'm going to try to focus on just calculations in this lecture. So do your reading. Okay, so in a partnership, one thing that we need to be concerned about is how are we going to split up income? So there's going to be an agreement when we are partners called the partnership agreement that specifies how we're going to divide income. If the agreement doesn't specify and it's silent, then we're just going to divide everything equally. So if you read a problem and it says the agreement is silent as to how income is divided, then you just assume everybody gets an equal divide. Otherwise, the agreement is going to specify certain things, which is what's so great about a partnership is that it's really flexible with how we can pay our partners. So the first thing that we're going to do when we are splitting up income is we'll specify a salary allowance. So maybe some partners work actually in the business more than others. So we're going to split up some of our partnership income based on what we call a salary allowance, and that comes out first. And then some partners, they might not work as much as other partners, but they put in more money into the company to keep it going. And so we're going to pay these partners interest on that capital account balance that they paid in. And so they get some interest in return for the partnership having some of their money. And then anything left over, we're going to divide according to how the partnership agreement says. So if the partnership agreement says everything's divided 50-50 after the allowances, then that's what we'll do. But it could be 60-40, it could be 20-80. Whatever the partnership agreement says is how we divide it, then that's what we're going to do. So here's an example in how I would set up dividing income. So I've got Dave and Reese. Dave has a salary allowance of $5,000 a month, so that's $60,000 a year. He puts capital into the company he has capital in the company of $160,000, and Reese has a $4,000 salary allowance a month, which is $48,000 a year, and $120,000 capital account balance. So in the partnership agreement, it says these are the salaries. It also says we have an interest allowance, 12% on capital at the beginning of the year. So these numbers here are capital at the beginning of the year. And anything remaining is split 50-50. So what we do is all throughout the year, we have this company or this partnership that's making money. And at the end of the year, we see that we have net income minus all our expenses, of $150,000. That's money that Dave and Reese get to split. So we have to figure out how do they split it. It's not an equal 50-50 because we've got some other allowances to consider first. So let's do salary first. Salary comes out first. Dave makes $60,000 a year according to his salary allowance. That's $5,000 times 12. And Reese gets $48,000. That's $4,000 times 12. So this total column is so important because you need to be keeping track of how much you've given away at every level. So far, of the 150 that we're trying to split up, I've given away 108,000 of it. Now let's do the interest allowance. Okay? Well, the partnership agreement says that we're going to pay 12% on the balances. Well, so Dave gets 12% times his 160, and Reese gets 12% times her 120. So 12% times 160 is 19,200 and 14,400 for Reese. So we need to add up how much did we just give away there? We gave away another 33,600. So this is a good time to subtotal to see where we are. We have given away $141,600 so far. Well, we can only give away 150, so how much is left that we haven't given away so far? So this is when you back into it. You back into it by saying, I want this column to equal 150. So I need to determine what number am I splitting that's remaining. Well, that's $8,400 more we haven't given away yet of our net income. Well, so the partnership agreement says divide remaining 50-50. So they're going to split this equally between the two of them. $4,200 and $4,200. So now in all, Dave has gotten 83,400 of the 150, and Reese has gotten 66,600 of the 150. So then we'll do a journal entry. When we did closing entries in Principles of Accounting, we closed our net income to capital. Well, instead of just closing it to one capital account, now we have partners. We have two capital accounts. So our net income was 150. So we're closing, which would be an income summary. So we're closing our income summary into our capital accounts, and Dave got 83,400 of it, and Reese got 66,600 of it. So we're just going to split it between the two of them. Next, I have an example here that you can go through on your own, where instead of 150 that we're going to be splitting up, Dave and Reese need to split up 100. So try that one on your own and then check your answer here. One important concept that you're going to see in a lot of problems is this weird way of sharing income and how it's shown. It's not shown in percentages, it's shown in 2 to 3, or it might be 1 to 2, or 4 to 5. Well, I'm going to show you how to convert that into percentages so that you can calculate how much they're sharing income. So let's say this, here's the trick. If two partners are sharing 2 to 3, that means there are 5 parts. 5 parts total. And one partner gets 2 of the 5, and the other partner gets 3 of the 5 parts. So this is essentially 40% and 60% split. So what's 1 to 2? 1 to 2 would be a total of 3 parts. So partner 1 would have 1 of the 3 parts. Partner 2 would have 2 of the 3 parts. What's 4 to 5? Well, that's 9 parts. So one partner has 4 of the 9. One partner has 5 of the 9. And then if it's 1 to 1, this is actually 50-50. So there's 2 parts. Each partner has 1 of the 2 parts. So that's the same as sharing equally. You can also have more than one partner. So you could say partner shares 1 to 2 to 5. So there's 3 partners, 9 parts. 5, 6, 7, 8, 9. So one partner would have 1/9. One partner would have 3/9. One partner would have 5/9. So that's how you work out the sharing in percentages when you run across that in a question. Okay, so here is another example that we'll run through quickly, except this time we actually don't have a whole lot of income, and we're going to run out of income just giving it away in allowances, and so we were giving away too much. And so what should we do in that situation? Okay, so we have Julie and Jill, and they have salary allowances. They have an interest allowance of 10% on their beginning capital account balances, and they divide income 2 to 1. So whenever you see 2 to 1, I want you to think the first one listed is going to be the 2, and the second one listed is going to be the 1. So if this is 3 parts, then Jill will be 2/3 and Julie will be 1/3. And they have net income of $75,000. So let's work it out. First, we're going to do salary allowances. Jill makes $3,000 a month, so that is times 12, $36,000 a year. Julie makes $2,000 a month. That's $24,000 for the year. So after salary allowances, we've given away $60,000 of the $75,000. Okay, now we're going to do interest next. So Jill gets 10% on her capital account balance, and Julie gets 10% on her capital account balance. So we've now given away another $22,000 of income. So let's subtotal. So right about now you should see that we have a problem. Like after the allowances, we've now given away $82,000, but we only have $75,000 to split. So ultimately, when you get down to this last total line, it needs to equal $75,000. So what you do is you giveth the remaining according to how they divide income, and you also taketh away according to how they divide income. So since we don't have any extra to give away here and split, we're going to take it out of what we've already given them. So we're still going to divide the remaining, even though it's a negative, according to 2 to 1. So we'll subtract $7,000 here because that's what we need to come out of the sharing in order to equal this $75,000 of net income. So to split it 2 to 1, Jill has 2/3 of the $7,000, which is actually $4,667. You can round it. And then Julie has 1/3 of the $7,000. So we're going to remove that from the list here, from her share. So then they share this income, the remaining overage they take out of their share according to how they divide income. So that will give Jill $41,333 and Julie $33,667. And together, that's the $75,000 of income that we were trying to split up. Okay, so that is dividing income. Now we need to talk about what are we going to do when we want to admit a new partner. So we could start a partnership with just 2 people and then later let more people join and become partners. This is very common in accounting firms and law firms to add partners later on. And so there's 2 different ways that this works. And this is how it works in the real world, okay? So you've got the partners over here. See my little partners? You got Tim, you got Joe, and you got Pete. Okay, we've got 2 partners already in the partnership, Tim and Joe, and Pete wants to be a partner. And then over here we have the partnership itself. So the first way that we could admit a partner is that the partners purchase directly from each other. So if they purchase directly from each other, let's say that Tim and Joe own 50% of this partnership, and Pete wants to pay $10,000 for 20% ownership, and he's going to purchase it directly from existing partners. So he's going to give Tim $5,000 and he's going to give Joe $5,000. And in return, Joe's going to give him 10% of his ownership, and Tim will give him 10% of his ownership. There was no transacting here between the partnership and the individuals. This was all between the people. So because of this, the total capital in the partnership stays the same, as if nothing happened over here. The total assets of the partnership stay the same. The cash didn't go into the partnership, it went into the partners' pockets. So that's really important because the journal entry is easy. You basically say, okay, the partnership has $100,000 of assets. This is the trial balance. And let's say that's all they have. They have assets of $100,000 and they each have a capital account of $50,000. So what we would do to record this transaction just between the partners themselves is assets don't change at all. Only capital accounts change. So we remove 10 from Tim's capital account and 10 from Joe's capital account, and we put the $20,000 into Pete's capital account. And assets didn't change, and total capital is still $100,000. So after this exchange, you can see that there's still $100,000 in capital. We just moved it out of Tim and Joe's account into Pete's, and we left assets alone. That's the first way. The second way is a little more complicated in that we're actually going to be transacting with the partnership. So here's Tim and Joe over here, and here's Pete. And it's the same deal. We want to pay $10,000 for 20% interest. Well, in this situation, Pete is actually putting the $10,000 into the partnership, and the partnership is giving him 20%. So in this situation, capital does change. We now have $10,000 more in capital. Total assets do change. We now have $10,000 more in cash. So this is going to be a different process. Before we accept Tim or Pete into the partnership, we're going to need to revalue our assets first. So this is, after we've had this partnership for a while, we've got equipment on the books that we've been depreciating, we've got buildings, we've got land maybe, and what we paid for it might not actually be what it's worth. It might be worth more. Well, Tim and Joe need to get credit for that. So let's say that instead of $100,000 that we paid for all our assets, they're actually worth $200,000. So before we let Pete in, we need to revalue all our assets and put that additional $100,000 into Tim and Joe's capital account. That way they get credit for that revalue, and Pete doesn't get any of that before he buys in. That's going to be the first step, revaluing. Next, let's see how this would work with a new example in bonus entries. Okay, so we have here two partners, Marcia and Helen. Marcia and Helen share 50-50 in this partnership. And Alex comes along and he wants to be a partner. He's going to be a third owner, and he's agreed to pay $31,000 to be a third owner. So what we do is capital is now going to be different. So we have to figure out what is the new capital. Capital before was $44,000. So total before Alex was $44,000. So now we're getting this new cash from Alex. And so we're going to be adding $31,000 to total capital. So this is our new total capital of $75,000. Well, we're only going to let Alex have a third of that. So we'll multiply that times 1/3, and we'll arrive at what we're going to put in Alex's capital account, which is $25,000. So now what you do is you compare What did Alex pay? Well, he paid $31,000. What is Alex's capital? Well, it's $25,000. So you can almost think of this like a bank account. Like Alex put $31,000 into his capital bank account, but he really only got credit in his account for $25,000. So essentially, Helen and Marcia got the difference of $6,000 in their capital account. So there's a $6,000 difference. We call this a bonus. Sometimes the new partner gets this bonus, and sometimes the existing partners get it. So in this situation, Helen got 3 of it, and Marcia got 3 of it, because they're going to split it according to how they shared capital, or how they shared capital previously, which was 50-50. So they're going to split this bonus 50-50. Here's what the journal entry would look like. The partnership gets the cash. So this is where our assets increase. And Alex gets $25,000 in his capital account. Well, our journal entry doesn't match, because we have that $6,000 bonus that's the difference. Well, in this situation, Marcia and Helen split that $6,000, and that gets added to their capital account. So think about, what's the new capital account balance? Well, Alex gets the $25,000. Marcia previously had $20,000 in her account. We just added another $3,000. So Marcia now has $23,000 in her account. And Helen had $24,000 to start off with. We just added $3,000. And so now there's $27,000 in Helen's account. So there's a total of $75,000 in all capital accounts, and that's what we were expecting right here, and that's what happened. This is how it got divided up. So I've included one more example here for you to work on your own. This example is Joe and Steve. They have a partnership where they share 2-to-1, and they're going to admit Chad into the partnership for $30,000, and he's going to get 25% ownership. So work through this problem and figure out, if I were to ask you, how much is the bonus? Who gets the bonus? How much is in everybody's capital account at the end? What's the journal entry? So work through this problem and as practice before you do your homework. And let me know if you have any questions.